How did the dot-com bubble erase $5 trillion from the U.S. economy when most of the companies driving the hype barely had revenue at all? Why did Wall Street claim that profits no longer mattered during the dot-com boom? And who walked away rich when millions of Americans lost their retirement savings? How did dot-com startups with no real business models turn into billion-dollar giants overnight, only to collapse just as fast and leave investors buried in losses? Why were early internet companies allowed to fake explosive growth using simple lines of code? And how did those manipulated numbers fool analysts, banks, and the entire financial system? What made America believe the dot-com era would rewrite the laws of economics? And how did that perfect storm of hype, fear, and greed trigger one of the biggest market crashes in history? Between 1995 and 2000, the U.S. stock market, especially the NASDAQ, exploded by over 400%. It was the fastest wealth creation in U.S. market history. The message from Silicon Valley and Wall Street was simple. This time is different. Analysts publicly declared that profits no longer mattered. Growth was everything. Internet companies could scale infinitely. Traditional business fundamentals were outdated. This narrative triggered the birth of the new economy, a belief system, not a financial model. What the data showed, but nobody wanted to admit, over 80% of all dot-com IPOs had zero profits at the time of listing. Nearly 40% had no revenue at all. Many didn't even have working products. Venture capital investments into startups surged from $8 billion in 1995 to $105 billion in 2000, a more than 1,200% increase. The bubble was being inflated not by technology, but by expectations, cheap money, and mass delusion. And Wall Street knew exactly what it was doing. From 1998 to 2000, investors poured money into any company that added .com to its name. It didn't matter what the business did. If it was online, its valuation skyrocketed. The IPO insanity, the average .com IPO doubled on its first trading day. Some soared over 300% before crashing months later. Companies with fewer than 50 employees were suddenly worth more than established Fortune 500 firms. Examples of the madness: a startup with no revenue could raise $50 million, $200 million in a single funding round. A company with a rough prototype could list publicly at a multi-billion-dollar valuation. CEOs used rising stock prices, not profit, to prove success. In some cases, entire valuations were built on manufactured growth, created by simple scripts running behind the scenes. Many dot-com companies boosted their numbers artificially using extremely simple techniques. 1. Fake user signups. A script could auto-generate thousands of new accounts daily. 2. Fake traffic surges. Bots could refresh pages non-stop, simulating explosive website traffic. 3. Fake transactions. Automated systems generated purchases that were never completed. 4. Inflated engagement metrics. Cron jobs imitated user activity to fabricate usage statistics. 5. Artificial demand reports. Companies manually adjusted dashboards before showing investors. This wasn't sophisticated fraud. These were 5 to 15 lines of code, yet it fooled venture capitalists, Wall Street analysts, journalists, retail investors, pension funds. Why? Because everyone wanted the numbers to be true. The market had become addicted to hockey stick growth curves, no matter how unrealistic. Pets.com is often mocked, but it perfectly represents the irrationality of the era. The data behind the delusion: the company raised $82.5 million in funding. It spent $1.2 million on a Super Bowl commercial. It went public with almost no revenue. It lost money on every single sale due to shipping costs. Its stock collapsed within 268 days of the IPO. The business model never made sense. Shipping dog food across America at a loss isn't innovation, it's charity. But Wall Street banks still pushed the IPO, the media still celebrated it, and investors still bought the dream. Pets.com didn't fail because it was unlucky. It failed because it was impossible. If Pets.com was irrational, Webvan was catastrophic. Backed by huge VCs, Webvan believed Americans would instantly adopt online grocery delivery. So the company built automated warehouses, robotic conveyor systems, delivery fleets, micro-fulfillment centers. Total cost, over $1 billion. The financial truth, burn rate, $50 million per month. Average order, unprofitable. Demand, massively overestimated. Expenses, too high to survive. Webvan collapsed in 2001, laying off 2,000+ employees overnight. Ironically, Amazon Fresh later reused Webvan's infrastructure. In other words, the failure funded the future, just not for the people who invested in it. The crash wasn't accidental. It was engineered. Investment banks profited enormously by pushing dot-com companies to go public, even when they knew the businesses were weak. IPO laddering. Banks encouraged early investors to buy shares during IPOs and agree to buy more later, at higher prices. This artificially drove stocks upwards. 2. Spinning. Banks gifted executives pre-IPO shares in exchange for future investment banking deals. This created a cycle of loyalty built on corruption. 3. False analyst ratings. Analysts gave strong buy recommendations to companies they internally mocked as worthless. Emails from the time show analysts calling these companies junk, disasters waiting to happen, totally uninvestable. And yet the positive ratings continued, because the banks earned 20 to 25% underwriting fees per IPO. Wall Street made billions. Executives cashed out. Retail investors lost everything. On March 10, 2000, the Nasdaq hit 5,048 points. That was the peak. Over the next 2 years, the destruction was historic. Nasdaq fell 78%. More than 50% of all dot-com companies died. U.S. markets lost $5 trillion in value. Telecom alone lost $2 trillion. 150,000+ tech workers lost their jobs. Retirement accounts evaporated. Startups shut down en masse. This wasn't just a market correction. It was a nationwide psychological shock. Americans who believed the internet would make everyone rich watched their futures disappear in months. Not everything died. Some companies emerged stronger than ever. Amazon lost 93% of its market value, nearly bankrupt, survived through aggressive cost-cutting, became one of the world's most valuable companies. eBay, one of the few profitable dot-coms, built a sustainable model early. Google avoided the hype, focused on real technology, developed AdWords, which later became a $1 trillion advertising engine. PayPal thrived during the collapse, created the PayPal mafia, leading to Tesla, SpaceX, YouTube, LinkedIn, Palantir. The collapse didn't kill innovation, it purified it. The bubble reshaped global finance and technology. 1. It created the infrastructure for the modern internet. Billions invested in fiber optics and data centers during the bubble became the backbone of cloud computing. 2. It taught Silicon Valley the formula for raising money. If you can promise growth, you can raise billions, even without profit. 3. It became the blueprint for future bubbles. You can see dot-com psychology in crypto meme stocks, SPAC, AI startups, fintech hype cycles. 4. It exposed how easily the public can be manipulated. A good story can overpower logic. A charismatic CEO can override data. A bullish analyst can override risk. The internet was new, but the greed was ancient. Every bubble follows the same script. A new technology appears. Investors believe this time is different. Valuations explode beyond fundamentals. Small investors rush in late. Insiders exit early. The bubble bursts. Everyone claims they never saw it coming. .com was not just a financial crash. It was a study in mass psychology, systemic greed, and the power of collective delusion. History keeps repeating because the incentives never change. If you think this story ends here, it doesn't, because the world of money is built on secrets, and every secret you uncover reveals a bigger one behind it. If you're not subscribed yet, you're missing the next move, the next conspiracy, the next collapse before it hits the headlines. Subscribe to MoneyLore Insider right now, because in this game, knowledge isn't power, it's survival. MoneyLore Insider, where finance meets mystery.